So I would make sure that drinks it and leave.
I'm sure I'll get
Because it's really rude to make
Either Mac to VGA or a DVI cable to go to the back here.
I like popcorn.
So while we're setting that up and everybody's getting beers, right? Is it? I turned this on mute. Yes, I did. Do you want me to unmute it?
Yes, please.
All right.
Oh, beautiful.
All right. So as Eric mentioned, I'm part of a group called the Pasadena Angels. And can I have a Corona? I will. Pasadena Angels is a group down in Pasadena, of all places, that invest in early stage companies. The group's been around since about 2000, 2001. And I've been the vice chairman of the group. As Eric mentioned, I'm also in charge of the screening process. Don't know how much time we want to spend going into the screening process and the Pasadena Angel process. We can do that at another time. Eric's asked me to come up here and talk a little bit about what an investor looks for in investing in a company. So first of all, while Eric's over there, there's, I thought you'd left. He puts a lot of work into this, and to hear people not responding to surveys and stuff, that's disappointing. So, you know, you do so much for this community and this group. I'd like to, you know, really applaud the people who participate and help you out. So kudos to you guys. My background, I have started a couple of companies. I've failed at a couple of companies. I've had some spectacular flame outs. I've also done okay on a couple of different things. I'm currently in the Pasadena Angels investing in companies. I've invested in about 12 companies over the last 6 or 7 years. My target is about 2 a year. The group invests in about anywhere from 10 to 15 companies a year. We have the funnel looks something like this, just to say how hard it is. We see anywhere from 20 to 40 business plans a month. And I go through each one of those. So over the last 6 or 7 years, you can imagine I've seen 3,000 or 4,000 business plans. I'm getting pretty good at weeding them out real quick. Weeding out the wheat from the chaff. I can tell the ones that are not going to hold interest for an investor. Picking the winners out of the wheat, that's much tougher. We can talk about that a little bit, but I'm pretty good at being able to weed out and understand what investors are looking for. We then bring about 6 to 7 maybe companies in each month, and they give a screening pitch. Those screening pitches then are evaluated, and we try and bring in 2 companies each month to pitch to the group overall. And there's about 100 members in the group, and so you're pitching to a group down at the Annandale Golf Club. Who's seen Caddyshack? Favorite movie, right? So as you drive into this golf club, there's this big long driveway and this big green, about par 5 off to the right hand side. I just want to see a plaid pant, Rodney Dangerfield walking out through that. It's just classic, you know, kind of thing what you would expect out of Caddyshack. But anyway, it's a very hoity-toity place. You can't wear jeans. So we get 2 pitches a month from entrepreneurs looking for money. What I'm going to, come on in, ladies. Grab a seat, grab a beer. Grab a beer, grab a seat.
How are you?
So that funnel's pretty wide at the top, pretty narrow at the bottom. If we're seeing 30 or 40 business plans a month and we're funding maybe 10 or 12 businesses a year, you can imagine the odds of success are slight. That doesn't mean that it's something you shouldn't attempt, because the feedback process is pretty good as well. I know Eric's getting into that feedback process right now, so we'll see where that goes. But we can take questions about the Pasadena Angel process, but I did want to talk a little bit about one piece of what an entrepreneur is looking for, and that's on the finance side. The finances are important, but they're not the critical driver. The critical driver is really about the team, and it's about the product, it's about the market size, it's about how you can be successful. And to me, it's all about revenue. But part of that is tying your finances back together, which means you've thought about the business, you've empathized with the entrepreneur, or you've empathized with the investor, and you know what they're looking for. What I'm going to try and give you tonight is a perspective on what I'm looking for as an individual investor into companies when we're trying to invest in individual entrepreneurs. So, shall I get started without a PowerPoint? Oh, this is going to be real fun. So this stuff is deep in terms of there's a lot of nuances and a lot of information. So I've given Eric the PowerPoint. Feel free to.
Are you having a problem setting that up?
Yes, I am.
Just a connector, he needs a Mac DVI out or.
Oh, it's a Mac.
Yep.
Unless anybody has a PC with a VGA port on it, because I can put this on a PC laptop real quick.
I did not bring my laptop.
And I didn't bring my cables, I usually carry.
Sorry.
I have a laptop in the house. That's.
I've got another Mac, but I've got a DVI out. If you have the little DVI to VGA.
No, I've got the
I usually carry one too.
I got DVI to HDMI, but oh well. All right, so here's where it goes, guys. I've got one copy of the PowerPoint. You can have that too. It starts with what I'm looking for is every investment that I make. I'm looking for somebody to have a home run. I'm looking at a company that can give me a 10x return. So if I put $100,000 into a company, I want to get $1 million back. And the reason is I'm going to have a portfolio kind of theory. I'm going to have 10 of those investments for $1 million, and I'm expecting each one of them to have that plausible case of a 10x return. The other part of that return is over a time period. I would dearly love to have it over 3 years. It's probably more like 5 or 7 years. So any pitch that I want to hear that I'm going to consider investing in, I need to have some kind of a 10x return over 3 to 7 years. That make sense? Okay. First, let me back up. Who here is really good with accounting? Anybody accountants? Cool. Makes my job a lot easier. So one of the things I teach at USC in the entrepreneurship program. I've taught a couple of classes. I've taught one class on what entrepreneurs or what investors look at for early stage companies, a derivative of this class. I've also taught a business plan execution class, which, back to your point, my mantra is ideas are easy, and execution and implementation is really, really hard. Coming up with ideas, we all have million dollar ideas all the time. That's the easy part. Coming up and executing on them, that's the hard part. So, back to my investment portfolio theory. I'm thinking that I'm going to invest in these 10 companies, and I'm going to get maybe, let's see, 10 companies at $100,000 each. For easy math, that's $1 million. So, of those 10 companies, I'm expecting 3 to 5 are going to fail, if not more. I'm expecting that 2 or 3 will give me my money back. I'm hoping that 1 or 2 may be giving me my 3 times my money back, and I'm praying to God that 1 is going to give me that 10x home run. So if you average that out and you do your internal rate of returns on those numbers, the early stage investor is looking for about a 25 to 35% internal rate of return, which means you're making that much money per year.
I don't think so. I got us all the way to the DVI from the HDMI. I don't think I got DVI for that.
It's all good.
I'll keep looking.
That's okay. Don't worry about it.
I got the Mac adapter. I got everything else.
There's an HDMI on that?
Hey Chip,
Yeah.
do you have just the DVI to VGA? Like just one of the little short Mac?
That's what I'm looking for.
Oh, you don't have one?
No, that's if I had that, then I was set.
I'll get it.
It's okay.
I do have a large screen television we can haul over here with 2 big guys.
You want to use that, Bob?
No,
You sure?
we're okay. I want you guys to ask questions, though. So that's what I'm looking.
So based on that, you're getting like a 13. That's not much of a return. Over
It's about 25 to 35% range of a return of 3 to 7 years, based on those worst case scenarios or best case scenarios.
Okay, so 3 to 5 fail. That means you get nothing back. Let me just pause on that for a second. You put in 50 grand, you get nothing back.
I've done that.
Yeah, that's rough.
Well,
That's not a lot.
yeah. Well, back to your an early stage investor is different than an entrepreneur, but it's the same mindset. I've got to go in knowing I'm going to fail. It's okay.
You've been doing this 6 years?
6 or 7, yeah. Inside of the Pasadena Angels. I did it before, more stupidly, before I got into the group.
So what is your IRR now, considering you still haven't, like, most of them haven't even cashed out?
Absolutely. Yeah, so that's a very interesting question. I can tell you I've had 4 exits. One of them I got money back. Okay. So my IRR sucks right now because I've been doing this for 5 or 6 years. What happened is I started in about 2006. 2008, 2009 came along. I basically reset my portfolio and say, okay, I'm starting from ground zero right now because we had to re-up and reinvest in a lot of companies. So I've still, yeah, it's a tricky question because the IRR is nebulous right now because I haven't got all the exits. And so I'm hoping to clip along at that level. That's my target. It's not there right now, but I expect it. Looking at my portfolio right now, looking what's in it, and talking with the entrepreneurs, I think it'll be there.
Totally. One that's coming, right? An exit you said was promising, so that'll help. The
Come on,
IRR.
7.
Yeah, I should ask how it's been since 2008 because that was kind of when.
Yeah.
Yeah.
I just reset everything.
Is that a bad year?
Yeah.
What typical investment range are you looking for?
In terms of?
No, in other words, you know, I mean, I don't know what level of an investor you are. So, I mean,
Certainly.
high end, low end. In other words, you're not even going to touch it, but it's
Okay.
not an X number.
Let me frame that in terms of the Pasadena Angels as a group. So these 100 accredited investors are sitting around and investing in companies, and we're usually looking at investing. The number is $250,000 to $1 million. We've invested up to $2 million. We co-invest with the Tech Coast Angels and the Maverick Angels a lot. So that's the 3 main groups in Southern California.
And okay, so here in that part though,
Mm-hmm.
so typically 250 to 2 million. What percentage is Pasadena taking on that?
That's a great question. Let's talk about the valuation question. I'll hit the space bar and we'll go to the next slide.
I like it.
Okay, it's without being too flippant and sarcastic, it's just really all about the math. I need a 10x return. So what you need to do, and this is where after a couple of beers it gets really complicated.
Give me some more.
Give me some more.
We'll get the real answer.
There's no checkbook, I promise. You've got to reverse engineer how to get me my 10x return.
Okay.
So easy numbers. So I'm going to invest $1 million. I need 10 million back for my 10x return. Okay. Now, if I need 10 million back in 5 years, you got to be up and you're going to sell your company for some number. Pick a number. 30 million. Okay. So 30 million. So now, what do I need of your firm? 30%. 33%.
So is that how you calculate it on the exit plan?
That's the plausible. That's what I do as an investor. I look at that plausible scenario to make my 10x return.
Do you always only deal with the 10x return? What would be the exception?
Greater than
20. Thank you. It's all about risk. I need that IRR, that 25 to 35% IRR, because of the risk I'm taking on. So if you can sell me that it's less risky, then I'll listen. But it's hard to have this stage of a company be less risky. We'll talk about that in a little bit, of what decreases risk. So just to play out the scenario for you guys, you invest $1 million and you want to get 10x return. You got to figure out how you're going to exit. So we were talking earlier. There's 3 really hard parts of being an entrepreneur. The first part is raising money. It's incredibly hard. The funnel's really wide, and we just talked about that. The second thing is probably the hardest piece, but it's relative, is creating value, generating revenue, creating a company. Doing all the hard stuff that we do. That's incredibly hard. The third part is exiting. By exiting, you've got to sell your company and your dream to somebody else and get that 30 million. So if in our examples we're talking about, you want to sell a company for 30 million and you're in the video gaming space, and companies sell maybe at 5 times revenue, maybe 10 times, whatever the number is. So you can reverse engineer. I need to sell for 30 million, and it's 3 times sales. So I've got to have 10 million in sales in 5 years to be able to sell for 30 million to give my investors back. So you've got to sell me a plan on how to get revenue up to $10 million. It's really all about the math then. So when a lot of entrepreneurs say, well, how much are you going to take? I'm sorry?
It's a best invested the hockey stick.
Oh, yeah, I'm going to show that on the next slide. It's such a good deck, too. So you show me how you get to your 10 million in sales. From there, it's pretty straightforward. If you need 15 million in sales on a 2x return, or you can get 10x your sales. I generally work off of sales instead of EBITDA. You guys know what EBITDA is? EBITDA is profit down after you pay all your bills. Because most people who buy you are going to be looking at your revenue. They couldn't really care less about your expenses because somebody's going to buy you and wipe those expenses out and bring in their own HR team and their own accounting team and their own legal team. They really couldn't care less about your expenses. They're looking at your revenue and your customers. So that kind of leads into the next point. For me, being the accountant guy, it's all about revenue. See, there's a hockey stick right there. It's really all about revenue. It's how you generate revenue, how you get to customers. We were talking about it earlier. You know, the sole focus of an entrepreneur has to be about revenue. You don't have any other problems until you have revenue. You really don't. Everything you do should be focused on getting revenue. There's a lot of things you have to do that are not about getting a customer. You have to put web pages in place. You have to have a lawyer. You have to have a lot of things to get revenue. I get that. But it's all got to be focused around getting to that customer.
So if I've got 10 million in revenue and 15 million in expenses, are you guys going to make it up in volume?
That's what Twitter does. So, you know, EBITDA doesn't matter as much as being able to take that 10 million and scale it up. How did you get to 10 million? What you're looking at is the cost of acquiring that customer and the lifetime value of that customer. And as long as those high-end numbers are good, then you're okay. Where it gets tricky and where I don't like to get into EBITDA, those below-the-line expenses are very, very suspect. You know, if your company has bought the RV and you're having to live out of that and you don't have any other expenses, well, now that's an expense to the company, but it really isn't. So, you know, it's just an easier equation to stay up at the revenue level. Certainly going to drive down into it, and we can talk about the kind of deals that investors look like, preferred stock and protective provisions, all that stuff. But basically, if you stay at the sales line, you don't have to worry too much about that. So yeah, it's all about revenue. Your expenses do matter. They have to be relative. You know, you can't be out of bounds. You can't be, you know, I tell my students it's really easy to go out and generate revenue. I can go stand on that street corner and sell $1 for 80 cents all day long and generate a ton of revenue. That's really easy to do. But at some point, you have to be profitable. So part of that equation is, you know, how do you get profitable? How do you sell it for more than it's worth? You have to have alignment on the growth, because the hockey stick we were referring to, everybody know what the hockey stick is on revenue? You're going along on revenue like this, and there's some transformative event, and all of a sudden your revenue goes straight up like this. You know, and every investor wants to invest right at that point of the curve. That's the sweet spot. So what you're doing is you're building a revenue graph out that says 0, 100,000, 200,000, 2 million. And you know, it just takes off exponentially. So every investor is expecting to see a hockey stick revenue curve. And you just have to explain why that revenue inflection point is there and what that means.
Your
Yes, sir.
hockey stick, what's that timeline, that zone? In other words, you're saying, okay, well, I'm going to put my money out there for 3 years, but I realize this company isn't going to make anything for 4 years.
Yeah. The question is why. So,
Because it's going to take that long to build it out.
so why wouldn't I wait and invest 3 years out?
Well, because it's going to take that money to build to that 3-year point.
So can you then extrapolate out and still show me my 10x return 5 years out? Okay. And you realize the farther out it goes, the more risky it gets. There's more variables, or there's more parameters. So that's all part of the equation. Back to the Twitter example, it's amazing to me that companies, a very successful company that overthrows governments, right? It's an amazing company. There's questions whether it's profitable or not. It probably is, but it's certainly not generating boatloads of cash. So how they do that, it's amazing to me. I will say this, my model is suspect because it doesn't take into account those exponential non-revenue type situations. You know, it's, it befuddles me, so I tend to back off from those. Does that help a little bit?
It does.
Okay. So back to the people being non-accountants. There's really three financial statements a business has. There's the income statement, and we just talked about that. That's revenue. It's all about revenue. All the expenses below that, they have to be in line. They have to be reasonable. We're looking for entrepreneurs to take a reasonable salary out of their company. The last thing I need is for an entrepreneur not to be able to pay the bills and not be able to put food on the table and not be able to put shoes on the kids. That's just more stress, and that's the last thing you need is more stress, right? So you've got to have a reasonable salary, and in LA, that's generally $80,000 to $120,000, just generally. We're not getting rich on $80,000 a year, and you know, you're still being able to, you know, cover the nut and feed the kids. So you want to be in a position where you have enough money to do that, but it's relative. It has to be in line. So after you get through the income statement, after you have your revenue, yes, question?
No.
Okay. You go to cash flow. Cash flow is probably the most important part of a business. Cash flow is whether or not you have enough cash at the end of the month. You can be profitable and still not be making money and still going in the red, because cash flow has non-cash things, or I'm sorry, income statement has non-cash things in it. Things like depreciation and amortization and net taxes and accrued salary, all this other stuff. It's not